Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to this week's Top Stock Picks of the Week. I'm Tracy Reinick, and I'm joined this week by Ben Rains with two top Zacks rank number one strong buys. There's a lot going on right now with earnings season started, but you don't want to lose sight of who has rising earnings estimates right now, and we're bringing you two of those that do. I'm going to lead off with my stock, which is on the leisure side of things. Not surprising. MasterCraft Boat Holdings, ticker MCFT. They are a boat builder and everybody's buying boats, along with RVs, anything outdoors. So MasterCraft has been reporting record earnings several quarters in a row, and including improving gross margins. And basically they can't keep anything in stock. But the last time we heard from them was in May for their last fiscal quarter, which ended in April. So a lot more has to be going on now as we've gone into the summer months. This is the key months for them, but the earnings estimates still look good. Let's take a look at all the fundamentals. So first we're going to look at the earnings surprise chart, because this kind of tells you what has happened during the pandemic. And you can see they had the one miss on as the pandemic hit, but then huge beats here, huge beat here. That was a 75% surprise. Here's another one, 47%. And then last quarter, another record quarter, 44%. The analysts can't really keep up with how good it is. So this is also one of the issues with this type of company. How long can it keep up this kind of pace? And some are beginning to think not for very long. So let's take a look at what is actually happening with those earnings estimates. So we're still in this fiscal year, and you see the big revenue growth rate there of 41%, thanks to the demand from the pandemic. And then you see huge earnings growth here too, as well, as we're seeing these record quarters of 133%. But then next fiscal year starts to slow, because the analysts, until we get the next earnings report, which won't be until September, the analysts are a little bit more cautious here that this level of hotness can continue on here in the back half of this year and into 2022 calendar year. So while they're seeing this double-digit growth still with 11%, and 13% on the revenue side, which is very impressive coming off of these new highs, it's still a little bit more on the cautious side. And so this is something to watch for some of these types of outdoor type companies that were big pandemic winners. Now, what does it look like translate to on the earnings chart? You can see that it looks good. We had that decline there in 2022, big gains still holding here expected in 2022 with the all-time highs. So this looks pretty good. Now the shares have had a huge run off of those March 2020 lows, as you can see here. And recently they pulled back a little bit here as people are starting to get a little more tentative here with what might happen on the leisure and hospitality side. Year to date up just 7.3%. And over the last 3 months, they're actually down 1.5%. So the momentum has been lost. But these shares are dirt cheap with those earnings rising so rapidly. They trade with a forward PE of just 7.3. So I don't know many Zacks number ones that are that cheap on a PE basis. So that's also something to keep in mind, is that the market and Wall Street is assuming that the best days are behind it, but they may be wrong, because a lot of trends have changed now after COVID, or now that the reopen is happening, and the outdoor play is still should be a strong one. But this is one to keep on your watch list, especially if shares continue to weaken here and get even cheaper. But I'm still liking the outdoor play, and it's still got that great Zacks rank of number one strong buy. Now I'm going to turn it over to Ben with his strong buy stock, and he'll fill you in on what's going on there.
Hello, Ben Rains here, and today I'm taking a look at Five Below, which trades under the ticker 5. 5 has crushed Target, Walmart, its industry and Dollar General stock over the last 5 years, up around 300%. Five Below sells what it calls trend-right, high-quality products loved by tweens, teens, and beyond. Five sells all of its products between $1 and $5, though it does sell products for over $5, under categories such as sports, technology, candy, books, and more. Five Below operates roughly 1,000 stores across nearly 40 states, and the discount retailer doesn't necessarily compete against Dollar General and others, since its offerings are geared towards teens and tweens, which is good to have a niche in this kind of category. Like all successful retailers, Five Below has improved its e-commerce offerings, offering same-day delivery options, and it recently announced in June that it expanded its Instacart partnership nationally. The company also continues to open new locations at an impressive clip, and Five Below's revenue had climbed between 20 and 30% over the last 7 years, with even larger growth before that. Five, though, did take a hit during COVID, but it did bounce back in the second half to post 6% sales growth in 2020. Five then topped our Q1 estimates in June, with revenue up nearly 200% from the easy-to-compare period a year ago to about $600 million, with it up 64% from the previous period in FY20, so the pre-COVID period in FY19. So 200% from the easy-to-compare period and about 64% from the period in FY19. Meanwhile, its EPS surged about 91% from that pre-COVID level to 88 cents per share. So looking ahead, Zacks estimates call for Five's 2021 revenue to soar 42% to about $2.8 billion, and then jump another 18% higher in FY 2022. And its adjusted earnings are expected to skyrocket 118% this year and another 18% in 2022. Five's positive earnings revisions help it land a Zacks ranked #1 strong buy at the moment, alongside a B grade for growth in our style score system. Plus, Wall Street remains really high in the stock, with 12 of the 17 brokerage recommendations that Zacks has coming in at either strong buys or buys, with none below a hold. Five stock is up about 90% in the last year to easily top the market and its highly ranked industry, but it has cooled off in 2021, with it up just about 9%. So as of Tuesday, it was trading about 7% below its records, and it's sitting below neutral RSI levels of 50 at around 46, which could give it solid runway and a better entry point for anyone looking to get in on the stock. Five also trades at a discount in terms of both forward earnings and sales compared to its own highs and year-long median over this past year. Therefore, investors with long-term horizons might want to consider this discount retailer that's dead set on it continuing to expand. So that does it for this week's top stock picks. Make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more.